Hi everyone and welcome to chapter 2. So in this chapter we are going to discuss about sources and analysis of financial risk. So this is continuation of the first chapter that we saw. So what are different types of risk? So risk can be categorized along different criteria. So there are economy wide risk, also called as market risk, or there are firm specific risk, also called as like system unsystematic risk. So it is economy wide risk, systematic risk versus firm specific risk, non-systematic or unsystematic risk. Then you have operational versus financial risk. Operational risk is nothing but business risk in day-to-day operations. Financial risk we talked about in the last class, so it has to do about like systematic risk, about financing risk, etc. There is continuous versus event driven risk too. Continuous risk you face all the time as a firm. Event driven risk happens like doesn't happen at a regular interval. It is more of an like itemized, right, specific instant risk. So what is financial risk? So financial risk is the risk arising from uncertainty of prices in financial market or from other terms of financial contract. So it is specific risk that happens because prices in the financial market fluctuate. So as a company, it could be prices of your goods and services. It could be prices of like let's say interest rates. So things change all the time in the economy, and the risk that as a firm that you face is called as financial risk. So financial risk can be categorized by source. It is market risk arising from market prices, counterparty risk arising from transactions with one another, and liquidity risk which arises from lack of market action. The focus of this course is on market risk. Okay, so in the last class we discussed like market risk can be divided into equity risk, interest rate risk, exchange risk, commodity risk. Counterparty risk is further classified as counterparty risk happens when you have payments that are due from either your customers or suppliers, and there is a possibility that they will not pay. So if you are selling on credit to your customers, then they might not pay. So that's a risk that you face as a firm. Okay, so these are counterparty or credit risk. And there are liquidity risk, that is financing can seize up, you might not be able to raise money, market liquidity can change, or cash flows can change. Okay, so what is the effective risk management? So main goal of risk management, the main goal of risk management is to prevent market fluctuations for interfering with the business. So to secure internal cash flows and be in a competitive position. Hedging is only possible if you know the exposure. So first step is to define and measure the exposure. Hedging is also only possible if the institution understands how effective the tools of hedging are, that is forward, futures, swaps and options. Okay, so this is more or less a recap of last class. So how do people deal with risk? They can be risk averse. So risk averse means they are sure, like they don't like to take risk and they only deal with things that they're certain about. Then you can also view good results as arising from skill and bad results arising from bad luck. We saw that everything good that happens is because of you, and everything bad that happens is because of the external variables. That people can deal with risk in this way. They think that risk is greater when there is less information about probabilities. They feel differently about risk depending on age, responsibility, experience, wealth, and gender. It may be thus be prudent to take human element out of risk management. So we saw this my risk management steps. You identify the risk, then you measure the risk, then you have management strategies for risk management, then you monitor how well you are doing, and if you think you will again go back to identifying risk. Okay, so this is an example that we'll go through. So assume that you run a small company in Canada, packaging and selling premium coffee beans for your customers, for your sales to customers. You may buy your coffee beans in Colombia, sort, roast and package them in Calgary and then ship them to customers in USA and all over the world. What kind of risk do you face? So the first step is we have to identify the risk. Now you're dealing with multiple countries. You are taking product from Colombia, processing it in Canada and then selling it to United States. So you are exposed to exchange rates in Colombia. You are exposed to exchange rates of US dollar. Okay, so you are exposed to that. Then you are also interested in coffee. So you are exposed to the coffee prices. So these are like first view, like first glance risks that you can identify. Then there are other risks, like something happens to your operation in Colombia because of a strike or a political unrest or anything of that sort, or something happens to your market in United States and all over the world because of recession. So that's a risk that you face. So there are different kinds of risks that you face. So identification of risk, our goal is to identify significant financial exposures and prioritize them in a manner consistent with management's desired risk profile. So there are interest rate risks. So there is absolute rate risk, that is the rate changes. Okay, convexity, that is rate of change of interest rates. So if rate of change of interest rates is faster or slower, that might impact you. Then there is correlation risk, how interest rates are correlated to your business and other things. They can be caused by interest rate sensitive assets and liabilities in your balance sheet. Then you can have currency risk. Currency risk can be further classified as translation risk. When you have a subsidiary outside of the country, you do business in that subsidiary and then you translate those financial statements back to home country. That's the translation risk. Transactions risk is when you're doing transactions with other country and you're exposed to exchange rates. Then economic exposure. So if you have some economic exposure to some country and the country changes in like certain aspects, then you can have issues. They can be caused by import exports arrangements, competitive pressure, etc. Then you can have also commodity price risk. So there is price risk, basis risk or correlation. So price risk means how the price of commodity is moving. You're exposed to that. Example, coffee price is moving. Basis risk, right? How fast and slow they are moving. And finally, correlation risk. How is it correlated to your business? It can be caused by procurement, inventory and sale elasticity. Now, what are the different tools that you have? So one advantage of listing the sources of risk is that it illustrates the fact that different risks are managed with different hedging instruments. For example, insurance policies are employed to manage firm specific risks such as fires. Then there are economy-wide risks such as exposure to interest rates that can be managed with specialized financial derivatives like forward, future swaps or options. So this is first part, we identify the risk. Second step is we measure the levels of risk. So we'll look into three principal sources of market risk: interest rates, exchange rates, and let's say price of crude oil or price of any other commodity. So interest rates, so you can see a pattern here. Interest rates in the 70s were low, then inflation kicked in the 80s. That's why interest rate went really high really fast, and over like since the 1980s interest rates have shown a downward spiral, but again now the interest rates are going up. Okay, so what are factors that affect interest rate? So expected inflation impacts interest rate. If inflation is high, the interest rates are expected to go up. General economic condition will impact interest rates. So if we are in a recession, more or less the interest rates might drop because the people are not buying, so the central bank might want to stimulate the economy. That's why they might drop the interest rates. You also have monetary policy. Okay, so whatever expansion monetary policy or contraction monetary policy that you're following will impact interest rate. Then foreign exchange market activity will impact the levels of interest rate. Government debt levels, if debt is too high, the governments cannot increase interest rates too much. That creates a cap. And there is financial and political stability that also impacts interest rate. Then if you see the exchange rate volatility, so this is US dollar, so this is dollar index. It is US dollar against all major currencies in the world. So you can see dollar was around $100 in the 1980s. It got really strong, and over the period dollar has weakened. The other currencies have taken a step up, but in the recent time US dollar has increased up again. So there is an upward trend in the US dollar. So what factors affect foreign exchange rates? So interest rate differences between two countries will impact it. Higher interest rate countries, fund flows generally happen to them and their currencies strengthen. Then there are international capital and trade flows that impact like exchange rates. International investor sentiments. So if investors are pro, let's say Brazil, then the Brazilian real would usually do well. Financial and political stability, monetary policy, debt to GDP ratios. So if debt to GDP ratio is too high, then foreign exchange rate generally depreciates. And there are other economic fundamentals that impact it. So example, they have looked at a commodity price of crude. So crude was relatively flat for years and years, then it bounced up, right? Because China started consuming a lot of crude, and then due to the financial crisis, it went down again. Now we are again back in a upward trend. So what impacts crude prices? So expected levels of inflation, interest rates and exchange rates, general economic conditions, cost of production, consumers patterns like demands and supply, and geopolitical stability. All these factors impact prices of crude. So this is an example of looking at different risk factors. Then you have to decide which risk factor seems the riskiest. So generally, right, interest rates and currencies impact more if you are not in a commodity business of crude. Next step is measurement of levels of risk. So we measure risk. The price levels, however, do not give the best picture. We have to see the level of risk. We need to know volatilities of time over time. So what is volatility? It is a measure of risk. The volatility is equal to variance of the percentage change in the risk factor, or it is calculated as, right, if it is an interest rate based thing, so it is interest rate t like right now minus interest rate t minus 1. So interest rate in the current time period minus interest rate in the previous time period divided by interest rates or variables in the previous time period. If you want percentage change, right, in terms of interest rates, you can also calculate it as interest rate in t right time period right now, interest rate in t minus 1, and 1 plus t minus 1, 1 plus previous times interest rate. So this is a way of looking at risk. We use volatility, rate of change. So if volatility increases a lot, that means, right, risk management is difficult because you don't know how the product is or the commodity is going to move. So you see the relative stability in like LIBOR was gone, right, since 2000, right, 7, because of the financial crisis. Right now also like LIBOR, like volatility on interest rates is very high. Then currency volatilities also impact. So we can see the volatility of US dollar. It has kicked up in recent times. Crude prices volatility also has gone up. Okay. Standard deviation is also one measure to look at risk. So higher the standard deviation, more risky is the underlying variable. So you can see like the standard deviation of interest rates was going down. Interest rates were quite stable, but then they kicked up. Okay, that creates issues. Same thing we can see standard deviation of risk, right, especially currency. Standard deviation was relatively low for currency, US dollar specifically, then it has again kicked up. And then crude price standard deviation, very like crude was trading flat for a long time, so within a particular range, but then it shot up due to China started to consume crude in massive amounts. Okay. And then we can also see Z numbers. Z numbers are, right, how much percentage of area lies to the left of it or to the right of it. So if Z is greater than some positive number, it means you're looking at probabilities that lie right of it. If Z is less than some negative number, you're looking again at right hand side of the it, right? Sorry, greater than some positive number, you're looking at some right hand side probabilities of things. If Z is less than some positive number, you're looking at like left hand side of it, and if Z is less than some negative number, you're looking at this area. So if Z is greater than some positive number, look at this area. If Z is greater than some negative number, you look at this area. Same way, less than some positive, and probability of Z less than some positive. Okay. So that was like different risk measures. Volatility and standard deviations are the important one. So we have to decide what it is that risk affects earnings or value or risk exposure. It is easier to measure earning risk exposure than value risk exposure. So value risk exposure means valuation of the firm. That value of a firm is derived, right, from all the future cash flows that it is going to get. So when you're looking at how risk is impacting value, you're looking at a multi-year impact. When you're looking at how it impacts your earnings, you are looking at a single year impact. So you can measure exposure in qualitative terms. Is the impact of given risk large or small, right? But not specifying how large or small it is. You can also measure risk, right, in quantitative terms. So we attempt to provide a numerical measure of possible effect. So in qualitative terms, whenever you're measuring risk, it will have a subjective judgment made on likelihood and consequence of the impact, usually presented in form of a subjective scale like high, average or low impact, or it can have gradations 1 to 10. Often it is based on experience. It is subject to behavioral biases. For instance, individuals tend to weight recent history too much in making assessment. So when you are making assessment, you tend to give priorities to recent history too much. Then you can also have it in quantitative terms. You can model the firm's operation and therefore cash flows and value, and you determine the functional relationship between a given risk factors and firm's cash flow or value. This involves measuring the sensitivity of the model to variation in an input. This exercise is also known as pro forma exposure calculation. The classic and simplest example is regression analysis. So in regression analysis, you have an dependent variable y, and like you have a variable y which is expressed as some other variable x. So if x is changing, you try to see the impact on y. You also look at risk horizon. So the size of the exposure is often sensitive to the horizon. Is the exposure measured over a day, a week, or a year? You also see asymmetricity of distribution. So many key risk factors are not well described by normal distribution. Many asset exposures are asymmetric. So we discussed in the last session like what does asymmetric means. So you have to focus on that. You also have to focus on quantity risk. So uncertainty over number of units to which the company is exposed. For example, trying to hedge a crop when one does not have a crop yield. That is important to have. So quantity risk is also important. So the simplest form is regression analysis, where variable y is cash flow over time, and it is dependent on these variables x, factor x, maybe interest rates, then inflation, economy, etc., etc., plus et. So let's look at an example of Walt Disney. So that Excel sheet that is attached, so it estimates how much risk Walt Disney is exposed to from the changes in macroeconomic variables. We'll use two measures: Disney's firm value and its operating income. We'll look at four macroeconomic variables: long-term interest rates, growth in the economy, inflation, and strength of dollar. Okay, so we are looking at how these four variables impact firms like Disney's like cash flows as well as Disney's firm value. So let me quickly show you that. So if you see Disney, okay, so this is the data that is given to you. So they have given operating income of Disney, they have given firm value of Disney, then they have given you interest rates, GDP values, then CPI values, and dollar weighted like exchange rate values, the strength of a dollar. Now you can do an exercise. I'll show you one exercise. So I'll copy this. Okay, we are looking at sensitivity of operating income and let's say interest rates. Okay, so this is interest rates and this is sensitivity of, this is operating income of Disney. So what is the first step? So first step is you find the rate of change. Now rate of change is this interest rate. So I'll go back to the PowerPoint and show you what to do when interest rates are given. So if you see, we were just discussing so there are two formulas for rate of change. If interest rates are involved, we generally use this formula. If interest rates are not involved, we generally use this formula. Okay, so since whenever you are looking at interest rates, like interest rates are involved in this case, we are going to use this formula. So this T, like I of T, that is interest rate right now, minus interest rate in the previous period divided by 1 plus interest rate in previous period. That is the rate of change calculation. So interest rate right now minus interest rate in the previous period divided by 1 plus interest rate in the previous period. So I want it in percentage. So this gives you how much rate of change, how much percent change, right, the currency is doing. So this should be 0. That doesn't really impact us because there is no data point before that. So we can actually start calculating from this point. So this is our data set, income and rate of change of interest rate. Now you can do regression analysis. Now how to do it? Select this cell, go to data, okay, then go to data analysis. We want regression. So why is your income? We are looking at impact on income because of impact in interest rates, change in interest rates. So we do okay. This calculates the impact in change in interest rate to income. So this is important for us. Like this is that X variable. So if interest rates change by 1%, right, your income is going to change by 3987, whatever is, like probably it's in millions. So $3987 million. So that is regression analysis in a nutshell. Okay. So you can do it for other variables, like how does Disney react to growth in the economy? How does Disney react to inflation? How does Disney react to strength of dollar? Then you have this measure called as value at risk, which we are going to spend a lot of time in the last chapter. But what is value of risk? It is the minimum loss that will be incurred X% of time. Sometimes it is defined as maximum loss 1 minus X of the time, but be careful, we generally do not use this definition. We stick to the first one, the minimum loss that will be incurred right at X% of time. Example, 1 day 5% var is 1 million. So it means in a given day, in a 1 day period, your firm will face like minimum loss of $1 million 5% of the time. So the wording is the probability is 5% that the firm will lose at least $1 million in 1 day, or the probability is 95% that the firm will do not worse than 1 million per day. We don't use the second definition, we stick to generally the first one. So we saw that like we want to focus on impacts that are on this spectrum. The impact is high and the likelihood is high. So that is how you prioritize the risk. The last step in the process is to consider the choices we can make in dealing with each type of risk. Based on whether the risk falls on the matrix, the response could be accept the risk, eliminate the risk, reduce the likelihood of the risk, reduce the impact of the risk, or transfer your risk using insurance. Okay, so tools for risk management. So key question to answer is which risk do you want to hedge and which you want to either pass through to your customers or investors or to exploit using options. Hedging is not costless. Hedging has costs involved. So cost may be explicit or implicit. A cost benefit analysis may be required. In subsequent chapters, we'll examine the key tools that can be used to carry out appropriate responses or risk management strategies. These tools will invariably be insurance or some type of derivatives, forward, futures, swaps, options, or credit derivatives. Okay, and finally, you have to monitor risk. So both firms and the environment in which you operate are constantly changing. It is very critical that risk management policies and procedures are constantly reviewed. Ensure they continue to meet both the needs of the firm and its stakeholders, as well as legal, legislative, and other standards set out by the industry. Ensure the action of the firm of the people involved in implementing the risk management strategy complies with the purpose and objective of risk management plan. Communication is very important. So that covers chapter number 2.